Welcome, everyone, to the Daniel Krug and Associates Market Update for June 2024. My name is Rocky Istvan. I will be joined in today's presentation by Daniel M. Krug. Today's agenda, what are we going over? We're going over the economic and market as of where we are here in June. And then we're continuing what we started last month, talking about Roth conversion strategies. So Roth conversion strategy part 2 today.
Yeah, this is going to be fun. I love numbers. I love numbers because when you do the advanced planning and you start running the numbers, it's just amazing how much money you can either save or make when you do these advanced strategies. So it's an awesome thing to me.
Yep. And
I get geeked.
And the market's cooperating, so I think it's a good time to look at these strategies and take full advantage of investing your money and getting it tax-free.
Yes.
In the growth.
Yes. Very good.
So
I guess you're going to start it off with the market, aren't you?
Yep. Here we are in the throes of summer. Kind of a warm June we're having here.
Hot
At least
June.
this week.
Hot.
But so is the market, and let's go on and talk about that. So we're going to start just with a summary of where we're at year to date in the middle of June here. The S&P is doing very well. We're up about 14.1% year to date, albeit the bond market overall is showing it's still down about 1%. And, as you can see below, I put some comments on just kind of an overview. The equity markets continue to show very strong upside growth, even though the economy is slowing, and the anticipated Fed interest rate cuts that we expected to happen, Dan, in the first part or the middle of this year have been postponed and possibly may not even happen this year.
Yeah, it's kind of like a countdown. 4, 3, 2, 1. Well, that's where they're at right now.
Yep. So we shall see. The economy is moving along pretty good. Inflation is not as low as the Fed wants it. So we're, having that to deal with, and thus they're reluctant to start lowering interest rates. When we talk about the bond markets, they have been improving, but they continue to lag in performance. And again, it's due to the delay in the Fed rate cuts. We kind of expected to see, a more of a resurgence and get back to a return of normal in the bonds. But, as long as rates stay high, that has held off. We do, however, expect once the Fed starts cutting rates to see some of these longer duration bonds and fixed income investments take hold and give us a pretty good 3 to 5 year return moving forward. When we kind of look at the economy by sector, where do we see the growth? Now, this is all sectors and all stocks. This is not just the S&P 500, so the numbers look a little different. The all sector return is 10.94% year to date. So that includes mid cap, small cap, not just the S&P 500. Technology obviously is still leading year to date, up 24%. Financial services are doing well, healthcare, but you can see the numbers have dropped off a little bit going into consumer cyclical. However, that's a decent rate of return. 2.79% for consumer cyclical stocks. Communication services is having a great year. Industrials, a decent year. Consumer defense, energy, basic materials, and utilities are doing well. The only negative really is the real estate market, and that's primarily the commercial real estate. We're still seeing that lagging. And again, commercial real estate is highly leveraged due to how they mortgage and take loans out against those properties. So those are kind of lagging, and we can see that kind of, Dan, continuing into next year as these companies tend to have to refinance every 3 to 5 years. So the fact that they're refinancing at higher rates than what they traditionally were accustomed to over the last 5 to 10 years, it's creating a real lag in those real estate investments.
You know, it's interesting, Rocky, when I look at this, because what we're talking about here when we're looking at the returns, especially the year-to-date total returns, is that this is also weighted, just like the S&P 500 is weighted. So when you're talking about 100% of these sectors, it's not equally weighted, meaning the technology is almost 30%, and that's what's driving the market, you know, as a whole.
Yep.
Now, obviously, there's other areas that are running as well, but if everything was equal weighted, the returns would be a whole lot lower.
Yep. Good point. So let's talk a little bit about where the economy is at year to date. You know, on the left side, you can see our June economic speedometers, the indicators, the 20 leading economic indicators that we track on a monthly basis. We're showing still a fairly good, strong economic forecast for the next 6 to 9 months. When you look back on the right side to where we were at in January, you can see that there was nothing green, nothing positive. However, you know, right now in June, we're still seeing positive movement in the economy, even though it is slowing. So, in fact, I wanted to point out kind of maybe something that might be a little bit of a surprise to some people. When you look on the left side of the chart, the third line under International Economic Outlook, you can see that there's a lighter gray shaded needle and the darker black needle. What that means is that the lighter shade was where it was about a month ago. So International Economic Outlook actually is improving. That's a good thing for us to consider when we're looking at portfolio allocation going into next year, Dan. We might want to start looking at some international allocation in the portfolio if that gets back to moving towards more of a green or a positive trend. So that's something we're watching as your advisors when we're managing the portfolios, and just wanted to point that out. But overall, we're seeing good economic signals, indications that the next 6 to 9 months of the economy is still chugging along and doing very well.
Well, it's interesting what you said about the international, because as you look at the overall portfolios for clients, there has been an uptick in the institutional money managers actually investing in the international markets as well.
Yep. So on this slide, what we're looking at is giving you a kind of a comparison so you can kind of see where we think, and the researchers at City National Rockdale believe things are going to shape up from a GDP and an inflation standpoint. GDP growth, the top line there, in 2023 was 2.5%. That's fairly standard growth for a mature economy like the United States or Central Europe. We're forecasting a slowdown. We're forecasting in 2024 that to slow down to be about 1.75 to 2.25%. And then when you look out into 2025, we're also expecting it to moderate, be about the same. So we're looking at 2 years possibly of slower growth. However, when you look at corporate profit growth, okay, companies that have been able to cut back, stay lean as far as their expenses and manage through a slower economy, their profit growth was only 1% in 2023. However, this year we're expecting that to fall somewhere between 9 and 12%, and next year somewhere between 8 and 12% in profit growth on average for corporations in the United States. That's one of the reasons we're seeing the stock market stay elevated and continue to grow, because the next couple of years look like those companies are going to return to making money over the next couple of years. Headline CPI for the year end in 2023 was 3.3%, which is significantly down from the high that happened in June of 2022, which hit over 9% inflation rate. We're seeing that in 2024 and 2025 to moderate and be more historically in line with the average. somewhere between 2.75 and 3.5%. Okay. Right now, I think we've been averaging in that 3.3 range this year. So the Fed is hoping that to slow that down a little bit more. That's why they're keeping interest rates elevated. And the good news, though, is we continue to see that slight slowing of inflation in 2025. So that's the plan moving forward. That's all a positive for the market. The core CPI is just another way of measuring inflation, and you can see that also is moderating. When we look at the federal funds rate, right now we're sitting at 5.25 to 5.5%. We expect a rate cut to take place, maybe one or two this year towards the end of the year, and get that rate somewhere down around 5 or just under 5%. Significant improvement we're expecting next year with maybe 3 rate cuts in 2025 and getting that down a full point to 1.5. Treasury notes, good news is for those fixed income investors, we're forecasting seeing an uptick in those Treasury note yields to get over 4% this year and maintain that into next year.
Well,
covered a lot there in just a couple slides.
Yeah, you did. And it's interesting when you're talking about where the Fed rates are going. For those, and this is really going to be interesting with the housing market, because if the rates get down to that 4% rate, that's still historically a low rate for mortgage.
Yep.
You get down to that, then you'll see some movement in the housing market. So anybody who can really kind of hold off making their moves, a little bit of patience over the next year and a half can save you a lot of money in interest relative to the mortgage, plus give you a lot more options relative to where you can move, where you want to move, and the housing as a whole.
Yeah.
So I think that's really neat.
And those that have to buy, the thing you can remember is if we're forecasting rates to reduce in the future, you can refinance.
That's right.
So it's a positive. It's not like we're believing if you financed a home today that the rates are going to stay higher, go higher. They're actually going to drop. So you'll probably have a good opportunity to refinance in the future.
Yeah. So for the younger folk where the housing market has kind of inflated a bit, the interest rates really kind of pushed them out of the game. But once that comes back, I think you're going to be fine. So now, next.
Move on.
Let's
talk about Roth conversion.
Yes, we're going to take a look at Roth conversion. So tax mitigation concepts and Roth conversions part 2. And the question is, and it always is, does converting make sense for me? And what we're going to show you is that for the most part, I think you're going to find that it does. So let's look first, and we're going to recap the Roth conversion benefits. The first benefit, and this is like any strategy, whenever you can stack the deck in your favor, you're going to be better off. And in looking at tax strategies, if taxes rise, you benefit. If they stay the same, you're really not losing anything. And what you're going to find in today's presentation is that even if they stay the same, you're going to be better off. Now, the other one is if you can control your taxable income level, you can also control your income tax. So using a Roth, which is tax-free, can really help you in the sense that it's tax-free, and IRAs are not. They're fully taxable. So if you can use Roth money to fund your expenses, ultimately you can end up with lower reported income. So that's a very good thing right there. Next, you got invest more efficiently for tax-free growth. And what we're talking about here is tax location investing. This is something that's not talked about that much at all. Matter of fact, you usually don't hear it unless you're working with a wealth manager that's dealing with high net worth clients. But in this scenario, what we have and what we're talking about is taking IRA money, which is fully taxable, and actually making it more conservative relative to the growth. If you have non-qualified money, for a client of ours, it's usually money that's in a trust or what we call a brokerage account. This money might be invested moderately. But with the Roth money, that's tax-free money. That's the money that's the most valuable for you. We would be more aggressive with that. Now, you're always keeping your risk at the same level as an average, but you're shifting the risk based on the location of the investment. The next one is, and this is really kind of key, is if you can convert more money to a Roth, you actually reduce the amount of IRA money you have, which lowers your required minimum distribution. So in this case, again, Rocky, I hear this from clients all the time. I don't even need my required minimum distribution, but yet I'm being forced to take it. Well, the more Roth money you have, the less IRA you have, the less required minimum distribution. So it actually helps you control your income that way as well. And then the last one, which again, most advisors don't talk about, stop paying Uncle Sam's advisor fees. And what do I mean by that? Well, when you convert to a Roth, you're going to pay the taxes that are due the IRS. That reduces the amount you pay in advisor's fees. Why? Well, if you paid, let's say, 15% in taxes, it reduces the account by 15%. It also reduces your advisor fee by 15%. So there's a lot of, when you're stacking this stuff up, it becomes a big benefit long-term for the clients. So let's go on to a little fun fact here. Which U.S. president enacted the New Deal that increased the highest tax brackets to date at that time to 63%? And what year did this take place? Well, Rocky, we'll give them what? A countdown of 5.
4, 3, 2, 1.
President Roosevelt in
Yep.
1932. So to date, that was the highest tax bracket in our U.S. history. Now, it's interesting because when you go and look at your top federal tax brackets by year, you can see that taxes were a whole lot higher than they are today. Matter of fact, they went as high as 94% at one time. And what kicked it off? Well, it started with Roosevelt's New Deal. And what did that come after? Well, it came after the recession. But it was like a double whammy to the citizens of the United States. Now, it kept going until it got up to 94%, and it kind of went up and down to about 91%. And at that point, JFK decided to do a tax cut and actually reduced it down to 70%. Then Kemp had a Roth had a tax cut, which dropped it down a little bit more. Then you had the Reagan tax cut, which dropped it down to 50%. And that was pretty significant at the time. And if you think about what Reagan said, he said when he was acting, he literally stopped working after he made $200,000. And you'd be like, well, why did he do that? Well, because at the time, the tax rate was at 91%. So anything over $200,000 in income, he was only getting 9 cents on the dollar, really. So it didn't make sense for him to work anymore because all he was doing is working for the government. Now, you keep going, and then you had the first Bush tax increase, but not after he lowered it. So he lowered it down to 28%, and then he made a fatal political mistake. What was that? Well, he said, mark my words, no new taxes. Well, what happened? He raised taxes, and that was the end of his administration. From there, you had Clinton come in, and he had a pretty significant tax increase up to 40%. Then you had young Bush go in. He had a tax cut, dropped it down to 35%, so that was the lowest in a very long time. And then Obama took over. And then there was a tax increase, brought it up to 39.7%. And then finally, we had Trump. He comes in and he has a tax cut to 37%, which we have been really lucky to have over the last, 7 years, 8 years?
Yep.
So it's been a pretty good run from a tax standpoint. But what is going to happen in 2026? Well, if they don't make any changes, it's going to go back to the Obama tax increase, which not only increased the tax rates, but it lowers the threshold, which is going to bring a lot more people into the higher tax bracket. So as you can see, taxes are here. We're actually well below average right now. We've got a debt that's out of control, a spending that's out of control, so it's likely that taxes are going to go up. Now, what does that mean when it comes to these scenarios? Well, the first scenario I'm going to show you is if you're investing your IRA and your Roth IRA with different target rates of return in a level tax environment, how does that all calculate out? And we're going to do this two ways. The first one is taking two IRAs of equal value, growing them at 7% for 10 years. The tax bracket stays at 25%. So we're assuming today it's 25, 10 years from now it's 25%. With that growth over that time period, 10% or at over 10 years, that 7% growth runs due to a high of $393,000. Now, we do have tax due, so we got about $98,000 worth of taxes due. So your net rate of return, in other words, after taxes, is $295,000. Well, not so bad, right? Well, if we apply some advanced strategies to this and we look at it from a Roth standpoint, let's see how the numbers will actually play out. So same scenario until you look at the conversion. So we're going to convert one of the two IRAs, pay the 25% tax up front, and then we're also going to change the rate of return for the location of the assets. In other words, the IRA, fully taxable, we're going to lower that return to 5%. The Roth account, fully tax-free, the one that we want to grow faster, is going to be at 9.5%. Now, we're still going to average 7% as a whole. So with a level tax bracket, this is how the numbers play out. By year 10, we have a total of $364,000, almost $365,000. Now, the tax due on it is only $44,000. And you might say, well, that's an awful lot, but we only had to pay tax on the IRA, not the Roth, because we already got that out of the way. And as you can see, 10 years later, the Roth account is greater than the IRA account. And the after-tax value ends up at $320,000. Okay, that looks pretty good, right? I mean, it's a lot more than what you would have had if you just maintained the two IRAs. Right. And you can see here the increase is about $25,000. This didn't increase any risk. The average rate of return was still the same, but it was the after-tax dollars that made the difference here. You ended up giving less to Uncle Sam. Now, let's look at scenario 2, rising future tax rates. So now everything stays the same, except 10 years later, the taxes rose to 35%. So now let's look at the math again. You run it for 10 years, it grows to the same amount, $393, but at 35% bracket now, you're paying out almost $138,000 in taxes. So your net rate of return is now $255,000 and change. So let's look at doing the Roth conversion. We're going to apply it in the same scenario here. So after that 10 years, Again, the IRA is growing at 5%, Roth at 9.5, but the average is 7. Only thing that has changed is the bracket at the end when we pull the money out. It's now 35%. And the total tax due at this point is only $62,000 and change. So your net rate of return ends up at $302,000. How does that shake out? Well, it's now over a $46,000 difference. That is not chump change there. That is a lot of money. That's buying a new car. Well, maybe 3/4 of a new car.
Yeah.
And in 10 years, maybe a half a car. But you've got more money to apply to it.
Yeah, you only have to buy 2 more wheels.
Yeah, so it's really interesting. When you start applying the advanced planning strategies, it just makes a world of difference in the amount that you get to keep. So when we're looking at all this, we're gonna actually bring in some more strategies to go ahead and kind of show people how this advanced planning can make a big difference. And then, when you apply it, line upon line, you end up with just a huge difference in the end.
Yep.
I mean, rate of return is important, don't get me wrong, and our clients get it. But it's the advanced planning that changes the game. And that can be applied to many, many people's situations. So just stay tuned for the next one. We'll go over additional strategies and scenarios so you can kind of see why it makes such a big difference to do the advanced strategies, and especially with Daniel Krug and Associates that really specializes in this type planning.
Well, I hope you guys enjoyed our presentation today. We hope you enjoy your day.
Absolutely.
And we will talk to you soon.
Bye-bye.
Goodbye, everybody.